I need you to sit with two numbers. Not because they make for a dramatic headline, not because I want to alarm you or excite you or push you toward a decision you have not thought through, but because the gap between these two numbers is the most important unresolved question in the precious metals market today. And the answer to that question, which number reflects reality and which number is wrong, will determine whether the investors holding silver right now are sitting on one of the most asymmetric opportunities of this decade, or whether they are catching a falling knife with no floor in sight. Number 1. Silver is down 22% since the Iran war started in late February. 22%. In 10 weeks, silver has lost more than a fifth of its value. At a time when inflation is running hot, when central banks are buying gold at record levels, when the monetary case for hard assets has never been more compelling, silver has dropped 22% and is trading near $73 per ounce. That is not a dip. That is a significant drawdown, and the investors sitting through it are asking a very reasonable question. Is this the bottom, or is there more pain ahead? Number 2, Bank of America, one of the most resourced financial institutions on earth, a firm with access to supply chain data, sovereign reserve flow information, industrial demand forecasts, and derivative positioning data that most retail investors will never see, is standing firm on a silver price average of $86 for 2026. Not backing away, not revising lower, standing firm. In the same week that silver is trading at $73, in the same week that a U.S. Navy frigate was struck by Iranian missiles in the Strait of Hormuz, in the same week that oil is above $112 per barrel, and global bond yields are surging on rate hike fears. Bank of America looked at all of that and said, $86 for 2026. Someone is right, someone is wrong. And today, Wednesday, May 6th, 2026, I am going to show you exactly who it is. Layer by layer, mechanic by mechanic, data point by data point. Because the answer is not in the headline, it is in the engine underneath the headline. And the engine is telling a story that the $73 spot price is completely failing to communicate. Let me start with the 22% decline, because you cannot properly evaluate Bank of America's $86 target without first understanding the mechanical nature of what drove silver lower. And I want to be precise here because precision is everything. Most investors watching silver fall 22% in 10 weeks draw the wrong conclusion. They look at the chart and they conclude that the market has reassessed silver's value and found it lacking, that the fundamental case has weakened, that something has changed in the underlying supply-demand picture that justifies a lower price. That conclusion is almost entirely wrong. Here is what actually happened. The Iran conflict that began in late February introduced a specific macro configuration that is uniquely damaging to silver in the short term, even when it is ultimately bullish for silver in the medium and long term. And that configuration has three components that work against silver simultaneously while leaving gold relatively better supported. The first component is energy inflation driving rate hike expectations. When oil goes from $80 to $112 in 10 weeks, which is exactly what happened as the Strait of Hormuz disruption took hold, it creates a supply-driven inflation shock that the Federal Reserve cannot easily address with rate cuts. The market looks at $112 oil, looks at PCE running at 3.5%, looks at four hawkish Fed dissenters, and concludes that not only are rate cuts off the table, but rate hikes are back on the table. And that conclusion creates selling pressure on silver specifically, because silver's industrial demand component makes it more sensitive to growth fears than gold. When rate hike expectations rise, investors worry about industrial slowdown. Industrial slowdown means lower silver consumption for solar panels, semiconductors, and electronics. Lower industrial consumption is bearish for a metal that derives 60% of its demand from industrial applications. Gold does not have this vulnerability. Gold's demand is 90% monetary. Rate hike fears hurt gold too, but they hurt silver more because silver has the additional industrial demand discount layered on top. The second component is the safe haven paradox. In a genuine military conflict, in a situation where U.S. Navy frigates are being struck by Iranian missiles in the Strait of Hormuz, you would expect safe haven buying to push both gold and silver sharply higher. And gold has indeed held up better than silver during this conflict, precisely because of its safe haven role. But silver's safe haven bid is weaker than gold's in a war scenario for a simple reason. Silver is associated with industrial activity. Industrial activity slows during wars, particularly wars that disrupt energy supply chains and create recessionary pressure. So the war that should be driving safe haven buying into both metals is simultaneously creating recession fears that discount silver's industrial demand, partially offsetting the safe haven bid that would otherwise be supporting the price. The third component is the paper market mechanics. When uncertainty spikes, when missiles are hitting U.S. warships and oil is surging and bond yields are rising simultaneously, the managed money funds that hold large COMEX silver positions reduce their exposure. Not because they have lost faith in the silver thesis, Because their risk managers mandate position reductions when volatility spikes and correlation across asset classes breaks down. This institutional deleveraging hits the silver futures market as pure selling pressure. It pushes the price lower regardless of what physical supply and demand are doing. And in a market as relatively thin as silver, institutional deleveraging can move the price by 20% in a matter of weeks without a single ounce of physical silver changing hands in a way that reflects genuine supply-demand rebalancing. This is the 22% decline. Three components: industrial demand discount, safe haven paradox, institutional deleveraging, each working against silver simultaneously in the specific macro configuration created by the Iran conflict. None of these components reflects a change in the structural supply-demand picture. None of them means the fundamental case for silver has weakened. They are temporary forces operating on the paper price. And temporary forces, by definition, eventually exhaust themselves. Now let me walk you through what Bank of America is looking at when they maintain their $86 average for 2026. Because a major institution standing firm on a price target that is 18% above current levels, in the middle of a war, with oil at $112 and rate hike fears rising, is not stubbornness. It is a supply-demand model that is telling them the current price is disconnected from the fundamental reality of this market. Start with the demand side, and specifically the World Gold Council's Q1 2026 report that was published this week. The report is titled Bars Trump Bracelets, and the title alone tells you everything about what is happening in the physical precious metals market right now. Global gold demand in Q1 2026 reached 1,231 tons, up just 2% in volume terms year over year. But the total value of that demand surged 74% year over year to a record $193 billion. Let me say that again. The dollar value of gold demand in a single quarter reached $193 billion. That is not speculative. That is not paper. That is physical gold bars moving from sellers to buyers at record prices. And the buyers driving that demand are not retail investors flipping positions. They are structural, long-term holders. Central banks, sovereign wealth funds, institutional allocators, who are building positions they intend to hold for years or decades. Now, why does a gold demand report matter for Bank of America's silver target? Because the same structural forces driving record institutional gold demand are also creating demand for silver. Central banks that are diversifying away from dollar assets do not buy only gold. They buy the entire hard asset complex. Sovereign wealth funds building inflation hedges do not stop at gold. They include silver because silver's supply deficit and industrial demand profile make it a complementary position to gold in a hard asset portfolio. And the institutional flows that the World Gold Council is documenting in gold, the shift from speculative trading to structural accumulation by long-term holders, are building in silver simultaneously, even if the silver price action this week does not yet reflect it. Now add the supply side. Global silver mine production has been essentially flat for years. The byproduct nature of 70% of silver supply, coming from copper, zinc, and lead mines rather than primary silver operations, means the supply cannot respond quickly to rising prices. The 7 to 10-year mine development timeline I have discussed in previous videos has not changed. And against that inelastic supply, you have a demand picture that is getting more urgent, not less, as Q2 2026 progresses. The AI infrastructure CapEx story, $715 billion committed by Meta, Alphabet, Microsoft, and Amazon, nearly double last year, is continuing to pull silver into semiconductor manufacturing and data center power systems. The solar deployment that requires silver paste at every cell junction is accelerating globally, and the monetary demand from institutional investors who are watching a U.S. Navy frigate get hit by Iranian missiles and concluding that dollar-denominated assets carry more geopolitical risk than they realized. That monetary demand is building even as the paper price stays depressed. Bank of America's $86 target is not a hope. It is the output of a supply-demand model that takes all of these inputs, runs them against a supply curve that cannot respond for years, and asks, at what price does this market clear? And the answer their model is giving them, the answer they are standing behind even as silver trades at $73 in the middle of a war, is $86 for 2026. That is a model telling you the current price is wrong. And when a model built by one of the world's largest banks with access to data most investors never see is telling you the price is wrong, you should ask very carefully whether the short-term forces pushing the price to $73 are more powerful than the structural forces the model is pointing toward. I need to address what happened in the Strait of Hormuz today because it is the most significant military escalation of this entire conflict, and it changes the probability distribution of outcomes in a way that directly affects precious metals investors. Two missiles struck a U.S. Navy frigate. Iran's Revolutionary Guards Corps Navy released a map designating areas of the strait under Iranian military control. Iran warned it would target any U.S. forces entering the narrow strait and cautioned commercial vessels and oil tankers against moving without coordination with its military. This is not a diplomatic skirmish. This is not a proxy engagement. This is a direct military attack on a U.S. warship by Iranian forces. And that escalation, the crossing of a threshold that has not been crossed in this conflict before, changes the geopolitical calculus in ways that the silver price is not yet reflecting. Here's what I mean. Before today, the market was pricing the Iran conflict as a prolonged but ultimately containable disruption. Elevated energy prices, persistent inflation, rate uncertainty, but no direct U.S.-Iran military confrontation. The peace proposal from Iran, the Project Freedom initiative from Trump, the ceasefire discussions, all of these created a narrative of eventual de-escalation that was being priced into both gold and silver as a reason to sell. The safe haven premium was being slowly discounted as investors anticipated resolution. Today's missile strike on a U.S. Navy frigate removes that de-escalation narrative from the table in the short to medium term. When a U.S. warship is hit, the political calculus in Washington changes. The pressure on the administration to respond with military force rather than diplomatic flexibility intensifies. The probability of a negotiated resolution this month, which the market was partially pricing in, drops significantly. And the energy supply disruption that is feeding inflation, suppressing rate cuts, and creating the macro configuration that has been punishing silver for 10 weeks, that disruption is now more likely to persist for longer than the market had assumed. For silver, this means the short-term headwind from rate hike fears is likely to persist. The industrial demand discount will continue as long as energy prices stay elevated and recession fears remain present. In the very near term, this week, next week, that is bearish for silver's paper price. The $73 level may face continued pressure. But here is the paradox. The same escalation that is creating short-term selling pressure on silver is simultaneously making Bank of America's $86 target more structurally credible over a 6 to 12-month horizon. Because a conflict that is escalating rather than resolving means the energy inflation is more persistent. More persistent inflation means real interest rates stay more negative for longer. More negative real rates for longer is the single most reliable macro driver of hard asset appreciation in the historical record. And more persistent geopolitical instability means more sovereign wealth funds, more central banks, more institutional allocators deciding that dollar-denominated assets carry a risk premium that hard assets do not. The escalation today is bad for silver this week. It is good for silver in 6 months. And Bank of America's $86 target is a 6 to 12-month projection, not a this-week projection. Let me show you the one number that puts everything we have discussed into precise quantitative context. The gold-silver ratio is sitting at approximately 61.5 right now. Gold at $4,540 something, silver at $73. 61.5 ounces of silver to buy 1 ounce of gold. Now let me tell you what Bank of America's $86 silver target implies for this ratio. If silver reaches $86 and gold holds at current levels near $4,540, the ratio compresses to approximately 53 to 1. If gold moves toward Bank of America's $6,000 12-month target, which they are also maintaining, and silver reaches $86, the ratio is approximately 70 to 1. And if gold moves toward $6,000 and silver moves toward the $86 average, with potential peaks significantly higher, the ratio compression that has historically defined the final phase of a precious metals bull market begins in earnest. Here is why the ratio matters for answering the who is right question. The current ratio of 61.5 is elevated relative to where it goes in a full precious metals bull market. In the 1979-1980 cycle, it compressed to 17 to 1. In the 2010-2011 cycle, it compressed to approximately 32 to 1. In this cycle, even a conservative compression to 50 to 1, well above the historic bull market lows, implies a silver price significantly above where Bank of America's $86 target sits. The ratio is not at a level that says silver is expensive relative to gold. It is at a level that says silver has significant room to run relative to gold before any historical precedent for overvaluation is approached. And when you look at the ratio in the context of what is driving this cycle, the AI CapEx demand, the solar build-out, the monetary repricing, the sovereign accumulation, the case for ratio compression toward 50 to 1 or below is not speculative. It is the natural mathematical consequence of silver's unique dual role as both a monetary metal and an irreplaceable industrial metal in the fastest growing technology sectors of the global economy. Bank of America's $86 target implies modest ratio compression from current levels. It is not an aggressive call. It is a conservative call that assumes gold performs in line with its own targets, and silver does what silver has done in every previous precious metals bull cycle. The question is not whether $86 is achievable. The question is whether you believe the forces that have driven this cycle are intact despite the 22% war-driven drawdown. And the supply-demand data, the institutional flow data, and the historical cycle data all say yes. Let me answer the question directly because you deserve a direct answer after everything we have just walked through together. The market at $73 is right about one thing. The short-term macro configuration created by the Iran conflict, energy inflation driving rate hike fears, industrial demand discount, institutional deleveraging, is genuinely bearish for silver's paper price in the near term. The $73 price accurately reflects the current positioning and sentiment of a futures market that is responding rationally to a specific set of short-term headwinds. In that narrow, short-term sense, $73 is not wrong. But Bank of America is right about something more important. The structural supply-demand reality of the silver market, the supply deficit that cannot be closed for 7 to 10 years, the AI CapEx demand wave that is embedding silver into the fastest-growing infrastructure build-out in human history, the solar deployment that requires silver at every cell junction, the monetary repricing that is building as dollar-denominated assets face escalating geopolitical risk. None of those structural realities have changed because of the Iran war. In fact, as I just explained, the Iran escalation makes several of those structural drivers more powerful, not less, over a 6 to 12-month horizon. The $73 price is a war discount applied to a metal whose structural supply-demand picture has not been changed by the war. Bank of America's $86 target is what you get when you strip away the war discount and look at what the fundamental supply-demand model says the price should be. The gap between $73 and $86 is not a gap between optimism and pessimism. It is the size of the war discount currently embedded in silver's paper price. And war discounts, like all temporary discounts, eventually close. They close when the conflict resolves. They close when inflation stays elevated long enough that the rate hike fears prove to be overstated. They close when the AI CapEx demand starts showing up visibly in silver supply-demand data that even the most skeptical analyst cannot ignore. They close when the managed money funds that deleverage their silver positions in response to the geopolitical shock rebuild those positions as the dust settles. The war discount in silver right now is not a reason to be bearish on silver's structural thesis. It is the mechanism through which patient, fundamentally driven investors are able to accumulate a metal with an $86 12-month target at $73. That is an 18% upside to Bank of America's conservative target from a price that reflects maximum short-term war fear. And if gold moves toward Bank of America's $6,000 target and the ratio compresses even modestly toward historical bull market norms, the silver price implied is significantly above $86. So who is right? The market is right about today. Bank of America is right about 2026. And the investors who understand that distinction, who can hold a position through a 22% war-driven paper market drawdown because they understand the structural forces that are more powerful than the short-term headwinds, those are the investors who will be positioned when the war discount closes and the price moves back toward what the supply-demand fundamentals say it should be. Bank of America is not backing down. The supply-demand data is not backing down. The institutional flow data is not backing down. The only thing backing down right now is the paper price. And paper prices, in a market where the physical supply-demand picture is as tight as silver's is, do not stay disconnected from physical reality indefinitely. They snap back. And when they snap back from a 22% war-driven discount, they do not drift gently upward. They move with the urgency of a market correcting an error. The error is being corrected. Bank of America saw it before the market did. The data says they are right. This is Asian Guy. If this breakdown gave you the framework to understand why $73 and $86 can both be simultaneously true in different timeframes, and why the gap between them is an opportunity rather than a contradiction, like this video and share it with one person in your life who is holding silver through this drawdown and needs to understand what the war discount actually means and how it closes.